Welcome back to this series of interviews with investment platforms. And this one is with a platform that most of us have heard of, Wealthify. And I have a chat with David Semmens, who is their kind of head of investment strategy. So he knows exactly where they're invested and why. So it's a really great conversation if you're thinking of investing using Wealthify or if you're invested with them already. I hope you enjoy. The purpose of this series is really to help people get started and to see the benefit of investing, and particularly in impact funds and investments. So why should anyone start investing? Why should they even bother considering it?
Well, I think the key thing for people to think about is there's a split between saving and investing. Savings is money that you have put aside for an emergency, and you might need that at very short notice, whereas investing tends to be putting money aside that you can afford to be subject to market fluctuations. Obviously, equities and bonds, you'll see their prices change day in, day out, whereas when you put money aside in a bank, you get a very small amount of interest. And hopefully, over the longer term, obviously, past performance is no guarantee for future performance, and your listeners or viewers will have that a lot, but over the longer term, you have seen markets outperform cash returns, as you would expect, because you're taking more risk.
So just on that returns point, I mean, if they were to choose like ethical or sustainable options, do people have to compromise performance? Is that what you're seeing?
So if you look at the FTSE for Good, for instance, if you look at their indices and you compare the FTSE for Good index versus the UK FTSE 100, which is the largest firms in the UK, they've actually got a fairly similar performance. And this comes from most firms are trying to do better as much as anything, so they are included in these indices. But what you'll tend to see is that those firms that have strong ethical policies even will see less of a drawdown during difficult times. They have maybe a lot more consideration to the policies in place. If you say that you're going to be excluding something and you guarantee that you're going to be doing that to your shareholders, you then have to go away and have the investigation to make sure that you are excluding that. So it's obviously very different from a company that isn't considering that. What we've seen over the last year is that those companies that are investing in, say, fossil fuels, for instance, and also the airlines, they've suffered because of COVID. So it's not necessarily as a value judgment on those sectors, but people who've been invested on the ethical side of things have seen a much better performance than those who weren't over the last year. And then some years that will change. I mean, unfortunately, it's no guarantee that you're always going to see that. But the academic research and looking at how funds and indices performed over the years, there doesn't appear to be a need to compromise on performance one way or the other.
Yeah, thanks. And is it still worth it for people who have only got a small amount to invest each month, say £10 to £50? Is it still worth them giving it a go?
Well, this sort of comes back to the split between the savings and investing. Obviously, you need to have a cushion in terms of savings. It needs to be secure. And that's something that you will have to do if you take our suitability questionnaires in order to become a customer. You need to have a certain level of savings to do that. But it's still, putting aside just £10 a month, obviously it builds up over time, and savings is meant to be a long run endeavor. The other thing that saving regularly month, it allows you to buy when the market is going up, but you're also buying when the market is going down. And ideally, if you just set aside, say, I'm going to have a standing order, and you're just putting it aside at £10 a month, hopefully you won't notice it. And then in, say, 5 years, you've actually got a nice investment pot to have a look at and take away, maybe buy something pleasant with, or just to keep adding to. So I think it is obviously always better to do something rather than nothing if your situation allows. But I think we offer from accounts from £1. So there is quite a low bar to be able to start with us, and one of the key tenets for us was that we wanted to make it so it was accessible to absolutely anyone. And some people will put in £1 and just try it and leave it, and they probably just forget about it. But people do hopefully see what we're doing and are pleased with it, and then come back and add more.
Yeah, lovely. So, when thinking about ethical, sustainable investments, does that mean that I'm limited in terms of the number of industries or the number of companies that are investable for me? Um, yeah, I mean, diversification is obviously a really important part of investing. Is that limited by choosing ethical?
So it's not limited. You will be reducing your exposure to certain industries, but that tends to be what people want. And that is a value judgment. And if you look at a lot of the research, and our customer research bears it out, is if people don't want to be exposed to, say, the gambling sector or tobacco, they're prepared to have that as an exclusion. And when you look at the indices, say the S&P 500, which is the largest 500 stocks in the US, if you're excluding tobacco, you are still going to have a performance very similar to the market. So it's not a great concern for diversification. It's when you start to try and access funds that have those particular exclusions. And one of the differences that we're seeing is that over the last 5 years, you have a lot more funds that are launching, so there is much greater availability of things. But for instance, if you want to have a pure vegan fund, for instance, there's only a couple of options. Whereas if you said to me, I want to have a fund that will exclude tobacco or weapons, that's much easier to do. And so I think it's coming from consumer demand. But when you look at what those funds are offering, they're very clear on the risk profile. But you can also, even if you want to exclude, say, fossil fuels, you can still have exposure to the energy sector. So you can still have exposure to alternative energy, but you won't necessarily have exposures to, say, BP and Shell. And that's a difference between ethical and sustainable. Is sustainable will be looking to exclude fossil fuels, and the market for that is still developing, because obviously fossil fuels have been such a large component of particularly European and US indices.
Yeah. And to really help investors get to exactly what they're investing in, what types of industries, what types of companies, it really helps for them to have an idea of their holdings. So the list of companies that they're investing in. Is this something that you provide your customers?
Yes, so we have it on our website. There is an Excel file which has got all of the companies that we have. You have to obviously ask the fund managers to make sure that they're happy with you putting that on, but that is something that we have on the website, and it is available for people to have a look. And we know that people have done that, because people have come back to us and said, oh, this is this. So it is of interest, and I think that those are the people who are particularly interested to that and want to go to that level of detail do really appreciate it. So we also have a screening process that we run to make sure that what our fund managers are saying they are excluding. So they send us all of the tickers for the companies and the bonds that they have within the portfolio, and then we run that through an algorithm, and we just check what sectors those companies are operating in. And for us, it's part of sort of a 3-line of defense. So we've got the fund managers who are looking at something and making sure that the companies are doing what they're saying they're doing. Then we have an external agency called Morningstar, which we subscribe to their research, and they also go away and do this check, and then we do that check as well. And for us, that's why ethical investing can cost a bit more, because there's a lot more due diligence in it. But I think most ethical investors appreciate that, because they understand that there is more time and effort that goes into it.
Yeah.
But if you're being told you're going to have something excluded, that needs to be excluded, and you need to be comfortable telling your customers that you are excluding that.
Yeah. So you've got sort of the 3 parties all deciding what is ethical, what should be excluded. Is that how you decide?
So we actually have 4 key exclusions. So we exclude weapons, gambling, the adult entertainment industry, and tobacco. And so we will exclude those, and when we first look at a fund, we will talk to the fund manager and explain these are the 4 things that we want excluded, and then we have a declaration that we will ask the fund manager to sign, saying that they understand that this is an exclusion. Just because for us, it would be able to say to our customers, we've gone out and we've spoken to people and they've committed to doing this is very important, because if you ask someone to do something and they say, yes, this is fine, and then 2 weeks later they buy a company that isn't suitable, and there's no sort of guarantee around that, that would be very disappointing for us and for our customers. So we've got those exclusions, and that, that obviously, as you say, does limit the universe somewhat. But for us, those are the things that made sense, and we're still left us with a large enough universe that we had a big choice of funds still. But instead of having tens of thousands of funds, you're now looking at having sort of a few thousand to look at.
Mm. So, and just two more questions just about that, how you choose who goes into the fund. So the first one is, what seems to come out top of the polls all the time is climate change. So I just wondered, number one, what your position on kind of fossil fuel industries and how you're managing that. And then the second one is, if there is sort of a big scandal, say on human rights or something like that, like Boohoo, for example, and their supply chains and that type of thing. How would you sort of manage those types of companies as well?
So on fossil fuels, at present, we don't exclude fossil fuels, but if you look at what the funds actually hold, most ethical plans have very minimal exposure to fossil fuels, but they don't guarantee they'll exclude it. And that's one of the key differences, as I said, between ethical and sustainable. It's still quite a small offering of fund managers who will actually guarantee an exclusion on fossil fuels and allow you to still have a portfolio that captures much of the rest of the market. And that's one of the key problems, is we would be able to offer a product, but it wouldn't be able to perform in line with what we would want it to. And for us, we'd rather wait and make sure we get it right, and also have the commitment from those managers that they are going to be excluding fossil fuels, because while they have minimal exposure, they don't actively exclude it. And we have those details on our website of what's on the sort of oil and gas industry as well. And we're very public about it. There's nothing that we're sort of uncomfortable with. And then when you look at Boohoo, so I think one of the problems is you have all of these companies who were doing due diligence and didn't come across this. When the news broke on the weekend, we were in touch with the fund managers on Sunday evening. They came back to us. They were in touch with the company, and the fund managers were very diligent. That's the great thing about ethical fund managers. They're all very passionate about the areas, and they were obviously very disappointed that had been in their fund. And the fund manager that we spoke to, who won't name names, but they gave us a lot of communication, they gave us a lot of detail, they kept us informed. And this came up on the Monday, and the story broke on the Sunday. And by the Wednesday, they'd sold the position. And so for us, they are taking very proactive moves, and it's obviously disappointing. And I think the thing is, they can only take away from that and say, right, we should be even stricter with our due diligence. We should be doing even more on this. And I think it is one of those things that you are always engaged on it. And that's the difference between the ethical side of things, where you are monitoring it, whereas passive, there's not really that monitoring.
Yeah. So that's great. I mean, to hear that you're having conversations with the fund manager about that. Yeah. So greenwash. There is a lot of greenwash out there. People know that, providers know that sustainable and impact and ethical and ESG, all of these types of strategies are now in high demand. So a lot of people are sort of tagging those labels onto their funds now. So there's so much good stuff happening, but there's a lot out there that isn't so good, right? So do you have any tips for individual investors on how they can cut through greenwash? What should they be looking out for, or what are the key questions they should ask?
So they should be making sure that they can see what is actually in the fund, and they're happy with that. Most fund managers will have either their larger exposures or all of their exposures available on their website. And I think, unfortunately, you need to take a trust but verify approach. As you say, it is a label that people are applying a lot, but you ultimately just can't take that, because there's no sort of legal standard for this. So you need to make sure that it's very clear that what you want from this fund and what you feel is ethical is actually what the ethical fund manager is going to be delivering, because there are different interpretations on it. And so that, that's why we have the 4 exclusions, and we're very firm on those. Other managers will have different exclusions that they want to apply, and they may align to other people's values as well. And I think that's the main thing to sort of look for. And also just having a look at their, the fund managers' literatures and how much they are talking about it. A lot of them will have very glossy brochures, as you can imagine, but they're also very academically founded, and they will have more information than you probably ever want on their website. I mean, all of their websites will be more than happy to sort of entertain you on that.
Yeah, a lot of information. A lot of it is actually quite hard to read for the average person, but I think that's a good tip in terms of just look at what's in the fund, right? And just see if it aligns with your particular set of values or the particular issues that you kind of care about and want to have an impact on. So there's a few platforms actually out there, not investment platforms, but platforms that are making it easier for, or are going to try and make it easier for individual investors to vote on the holdings that they have, and just to exercise their shareholder rights, right? So I just wondered if you've been seeing that coming through, and what you think about, say your customers being given the opportunity to actually vote at company on shareholder resolutions to have even more of an impact with their money.
So I think there's a difference between the individual shareholders who are actually holding the companies directly, who can have an impact, and then through the fund managers, these systems are set up, and you can pass on your opinion on various points, but ultimately it's the fund manager who is going to be voting on those. And so it is good to let the fund managers know what you think. And I think this just shows that the level of engagement is only going to increase. And I think for us that's the thing. A lot of the thing on the passive side, maybe obviously people want to see how they are doing, but kind of beyond that, there's not necessarily the same level of engagement. And so for us, it is something that we can sort of talking to the fund managers around, but it's still non-binding at this point. So it's more of an informational offering. And I think the key change will be when that can either become binding, or that it just becomes. Yeah, sorry, I messed that one up.
It's all right. No.
We can chop that bit.
Yeah, we can just chop out that last bit. Yeah, great. So at the moment, what we're seeing is individuals being able to sort of signal what their kind of vote might be, but ultimately it's up to the fund manager. But maybe in the future it will be binding, and the fund manager will have to do what they're told to do by their investors, the asset owner. Okay, just a couple of last questions. So the first one is just on investor diversity. So something I'm always banging the drum about is increasing investor diversity. So having more women investing, more people of colour, more people on lower incomes, which is something that you mentioned earlier about making investments super accessible by bringing down that minimum investment amount per pound. But how about in the other areas? I mean, what do your customer base look like, and are you seeing diversity kind of grow and build?
I mean, I think the key thing is having it from a pound means that ideally anyone can do it. For us, you are seeing a younger than average people coming into the industry and investing with us. And I think that's probably typical for all of the robo-advisors. We see sort of a fairly even split, but I think ultimately it's something that's got to be sort of changed across the board. Really, I think all of the companies I think are trying to improve this, but it's unfortunate that it's sort of fairly slow to change. You're not going to just see a snap change in it. And I think there's still perhaps a different approach within, say, the UK compared to the US, where in the US people are much more passionate about investing rather than saving. In the UK, we're a bit more cautious around that.
Yeah, that's really interesting. Yeah, and I think with I ran a campaign to get more women to invest in 2018, and yeah, I think there needs to be a bit more of that, really. It's like speaking directly to these new types of investors and educating and reassuring them that it's actually a good thing to do, which hopefully, you know, this video series will help with. And then just the final question then is, at what point should somebody go and speak to a financial advisor? Yeah.
Well, I think that one of the main things that you can get, say, from a financial advisor that you wouldn't get from us is tax advice. And I think once your personal situation becomes complicated, that tax considerations are maybe going to be driving your investment decisions, then that's probably the point that you want to think about going to talk to a financial advisor.
Yeah. Okay, perfect. Well, look, thank you so much for joining me. I'm going to put some of your information in the description below so people can head over to your website and just have a look around for themselves. But thank you
Excellent.
so much.
Thanks for having me.